We now move to Unit 4 in Wealth Management, and this will talk about primarily insurance. And then we'll extend Unit 4 in terms of understanding about what are the key ethics in wealth management, right? Now, insurance is a vast topic. It primarily deals with the risk cover that is provided to an individual, and insurance in a way is what the risk cover is. So we're going to look at what kind of risks are there. How do you try and plan covering for those risks, and what are the various kinds of products that are available in the market when you try and deal with those risks, right? So that's what is going to form the crux of our discussion under insurance. It's a vast area, so we may not be able to cover everything, but we'll cover a reasonable chunk of insurance, particularly insurance getting divided in terms of life and non-life, right? Non-life gets further divided into a multiple other categories, which we will discuss at some point of time. But life insurance is one of the most critical components in terms of insurance planning or wealth management for an individual. We've already seen that how can we create portfolios of mutual funds. Now we need to get further about what do we mean by the insurance components around those mutual funds and around the wealth of a particular person, right? Let's understand broadly that insurance deals with risk management, right? Now, risk management could be broadly of four types, right? You could accept the risk, you could avoid the risk, you could limit the risk, or you could transfer the risk, right? Accept, avoid, limit, and transfer. Risk acceptance assumes that there is risk and you have accepted it, right? Once you've accepted it, you'll take whatever the cost is there, and essentially, the risk is taken care of. So, for example, there is a risk in India that employees could get affected by an illness like dengue. So the company would basically cover everyone on that. So they'll say, okay, some amount of the money is kind of put aside for this. We have accepted the risk and we keep that. Right? That's a way of managing risk. The second way could be risk avoidance, which is the most expensive option. Typically, in this case, you are taking a decision that avoids the risk altogether. For example, stopping a business in any country with political instability. Now, if you think about it, if a global corporation was going to take decisions on closing businesses based on political instability, then a company like GE, for example, which operates out of about 100 countries, would keep closing and opening offices every now and then, right? So that's an expensive option. Most companies actually don't do this unless you're doing it at the onset itself. So you might decide that I'm not going to go and put an office somewhere. That's fine. But if you already have an office, most companies don't go down this route because that's an expensive route, right? The third could be risk limitation, which means you can take part risk, right? Like hedging. Now, what do we mean by hedging? Let's say I'm going to get $100, and at the current rate, that's going to be 6,700 INR. I want to hedge part of it. So I say that I'll fix 50 at 67 and let the remaining 50 come at whatever rate comes in. So if the rupee goes to 70 or it goes to 65, the multiplication happens with those numbers, but half of it I have kind of fixed. So a lot of the time companies try and limit risk in terms of seeing that, okay, I don't want to take the entire range of risk. I'll try and limit it to a certain level, and that's called as risk limitation, right? Finally, risk transference, right? Now, this is where the concept of insurance comes in, where a company or the entity is saying that I'm going to transfer the risk to another entity, right? And why is that other entity going to take that transference? Is we'll discuss that because of a variety of factors on how this transference works. But that's basically how risk management comes into perspective. These are the four broad ways that we're going to look at, right? Now, our primary focus is going to be this point 4, which is the transfer of risk, which is where insurance comes into place, right? So let's understand the concept of insurance. What is insurance? To understand this, we can go back a little bit about the history of insurance. Now, this is just anecdotal and for knowledge purpose, but this is not necessarily going to get tested anywhere. Insurance started initially with the army and armies of Europe, right? More specifically, Spain. Uh, so, in the European armies, every soldier used to pay some amount, right? Pay some amount towards creating a fund that would then be given to the families of soldiers who passed away during the concept of during the war, right? So that was the initial concept of life insurance. Similarly, in general insurance, the concept of insurance came from the shipping industry. Unlike today, historically all goods were transferred using shipping, and there was a big problem in terms of actually figuring out what would happen to the ship. So traders and merchants used to kind of insure the ship, saying that if something wrong happens, then there is some sort of a risk transference, right? So that became a big portion as well. Now that is what is insurance, where you're saying that you will collect small amounts from many, and this will benefit some, right? So the concept is that not everyone will need the benefit, only a few people will need the benefit. You collect small amounts from many people, and then you distribute that to the some people who really need that money. That's the broad concept of insurance, right? So it's essentially risk transference in the sense that all these people who are giving the small amounts are transferring the risk to the insuring company. And the insuring company takes care that if the money is needed by one person at some point of time, that's when it is paid to that one person. Correct? Now, we've seen this in earlier discussions that insurance needs of a person would typically increase a little bit with age, and this increase happens as number of dependents increase. As the number of dependents increase, the insurance needs increases. Then, as the person reaches somewhere around the age of 45, 50, there are a couple of things that happen. One, dependents go down. Why? Because kids get to earning around that age, 50, 55 for most people, right? Second thing, people have saved enough. People have saved enough money by that age, right? So post that, you do not need the insurance to be as high, and insurance needs typically go down, right? So insurance needs typically are highest when the kids of an individual are close to higher education. That's the simple thumb rule that you have to say, that for any individual, if the kids are close to getting to class 10, 11, 12, that's where bulk of the insurance requirement would be. That's where there is the biggest financial risk of of the person not being there. So that's basically how insurance needs increase. This is with specific discussion to life insurance. Obviously, other insurance needs could change differently. So this is, we must specify these are life insurance needs, right? Now, what are the major characteristics of insurance? The first major characteristic is that it works on a law called the law of large numbers. We saw many people pay and some benefit. So the idea is that if you take a sufficiently large numbers, if you take a sufficiently large number, larger the number of people or the pool of people, larger the spread of people, the less the chance of losses, and hence the lower the amount everyone will have to pay. So if you're selecting 10 people, everyone will have to pay a certain amount. But if that number increases to 100, the amount will reduce further. Number increases to 1000, the amount reduces. 10,000, the amount reduces further, and so on and so forth. So as you keep increasing the number of people who are basically willing to fund this corpus that is going to be used for everyone, that's how the law of large number works. So that's the first important crux when we look at insurance characteristics, right? The second one is that insurance will protect you against a risk which is accidental and unintentional. You cannot go and put your bike into a wall and claim vehicle insurance. They will not give it to you. So it cannot be orchestrated. It has to be accidental, right? Which means you have not planned it, right? Or not planned. Only for unplanned, unintentional, accidental requirements is where insurance works. You can't plan killing someone, for example, just to get the insurance component playing out. That doesn't work. The third thing should be that the losses should be determinable and measurable. So the loss should have some value attached to it. You can't have a vague loss value, right? You have to have a specific objective loss value assigned to it. Till then, insurance does not work. The fourth is no gain scenario. Usually in insurance, you should be only able to cover your losses. You cannot make money. Take car insurance, for example, or vehicle insurance, for example. You cannot gain money out of it. If you go and if someone is involved in an accident in a two-wheeler and that's insured, only to the extent of the losses will the payment be there. There cannot be a payment that is higher than the losses in that case. So you cannot gain money in insurance scenarios. And finally, the premium should be viable. So if I want to cover myself for 200 crore, that will be not allowed, right? And that will be not allowed because I will not be able to pay the premium. So when you buy an insurance, typically it will evaluate the salary of the insured person to gauge whether this person can actually pay the premium year after year after year. So the premium should not be exorbitantly high, correct? So these are the major characteristics that you will see with insurance policies. Law of large numbers. The event should be accidental. The losses should be determinable and measurable. People should not gain out of that loss or insurance. And the premium should be viable for anyone who's purchasing the insurance product. These are the major characteristics of any insurance. Now, what kind of insurance comes in? We largely divide insurance into two parts. One part is called life insurance, right? That's here. That's your life insurance. Everything else will basically, so these three and these two will fall under what is called as non-life insurance, right? So that's non-life, 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 and non-life. And this is the only life insurance component. Life insurance protects you against loss of life. Non-life insurance covers against either property or car, vehicle, or travel. So if you book an airline ticket, you can take an insurance which protects you against inordinate delays or loss of baggage, right? So loss of bags, etc. Personal accident insurance. If someone meets an accident, some payment gets done there for the treatment. And then health insurance. Healthcare costs are huge these days. So people need a health insurance which would cover any kind of issues that might come up because of healthcare costs or treatments, right? So broadly, you would have life insurance and non-life insurance. Both are important, remember. Life insurance is obviously important because there is a value of every human life and there's a financial risk that is associated with human life not being there, especially if this is the primary breadwinner of the family. With non-life portions as well, people, for example, put their life savings to buy a home. It is absolutely important to do property insurance there. What happens if an earthquake strikes? Correct? Car insurance is actually mandatory, and that's mandatory because not because people should care for their cars, but that's because usually accidents involve two parties, and so both the payments have to be done by the insurance firm. So that's mandatory. Travel insurance is not mandatory in case of delays, loss of bags, etc. We've already seen health insurance and personal accident insurance. Every individual should ideally have at least a life insurance and a health insurance. These two should not be compromised at all. So as a wealth manager, your primary role is to evaluate if an individual has these two insurances covered, right? So these two risks have to be covered for each individual. Next, we move on to how insurance is basically sold. So if you look at the life insurance component, the market scenario today is insurance companies talk about return generation through life insurance policies. So they say invest in life insurance, right? They also talk about tax benefits because government gives some benefits on investment in insurance plans. And then finally they say, okay, your life risk is also covered essentially, right? So that's almost like a bonus that they're giving, where they're saying that the primary objective is return generation and tax benefit. These are the two primary objectives, and risk cover becomes the secondary objective. That's how it is perceived, that's how it is sold, and that's how it is positioned in India, right? That's why very few people basically have the entire risk cover in India. It's about, it's said that about 6 to 7% of the population is insured, which is very, very minuscule. Technically, a large chunk should be insured. More importantly, the amount of insurance that is there is very, very little, right? How should it ideally be? Remember, you can get returns from other products as well, like mutual funds. You can get tax benefits from other products as well, correct? The primary requirement should be the risk cover. That's the primary need of buying an insurance. So the way it should be perceived is, does someone have adequate risk cover? That's the first question a person needs to ask. That's your primary question. The secondary discussions could be that, is there a potential risk return generation? And is there a potential tax benefit? There are 20 other ways to save taxes. There are 20 other places to generate returns. Risk cover should be your primary objective while evaluating whether someone has insurance or not. And as we get to the end of this particular section, a few questions. Give examples of any three kinds of insurances. What do we mean by law of large numbers? And what do we mean by the event whose risk is covered should be accidental, right? Thank you.